Late January 2026, President Prabowo Subianto takes the stage at the World Economic Forum in Davos, delivering a highly confident pitch to global investors. He outlines a bold vision to restore Indonesia's economic growth to 8%, a level the country hasn't seen since the mid-1990s. But exactly 4 days later, the reality on the ground looked entirely different. The Jakarta Composite Index plunged more than 10%. The sell-off was so severe it triggered a mandatory circuit breaker, completely suspending stock market trading. In that brief window, roughly $80 billion in market capitalization simply evaporated. Government officials quickly stopped talking about an imminent economic boom. Instead, the finance ministry publicly declared that Southeast Asia's largest economy had entered survival mode. So, how did a rising economic powerhouse, with supposedly solid fundamentals and immense global potential, suddenly find itself teetering on the edge of systemic collapse? The initial cracks came from outside Indonesia's borders. In early 2026, an escalating conflict involving the US, Israel, and Iran began threatening global shipping routes. As a result, Brent crude oil spiked, hovering dangerously close to $100 a barrel. At exactly the same time, volatile monetary policy in the United States kept interest rates high. That dynamic acts like a financial vacuum, sucking investment capital out of emerging markets as investors chase safer, higher-yielding American assets. These combined pressures hit Indonesia's currency hard. The rupiah rapidly depreciated, breaching a historic low of 17,000 to the US dollar. To stop the currency from bleeding out entirely, Bank Indonesia, the country's central bank, had to act aggressively. In a single month, they burned through $3.7 billion of their foreign exchange reserves, selling dollars to buy rupiah and prop up its value. When that wasn't enough, they resorted to a secondary panic measure, pumping another 90 trillion rupiah into the secondary market to buy up government bonds and keep the financial system liquid. These external shocks stripped away the narrative that Indonesia's domestic market could weather any storm. With the currency sliding and reserves dropping, the cost of stabilizing the country shifted directly onto the federal budget. Facing a severe global energy shock and a plunging currency, standard economic logic dictates aggressively tightening the belt. Instead, the Prabowo administration pressed forward with massive populist spending campaigns. This chart tracks the 2026 federal budget. Alongside standard spending is a massive new block, a $28 billion initiative for free schoolchildren meals. Stacked right on top is a 37% spike in national defense, adding immense weight to an already strained fiscal system. Behind the scenes, the administration's newly established sovereign wealth fund, Danantara, quietly secured billion-dollar loans at double the cost of standard government bonds, creating massive hidden liabilities for the state. To make matters worse, these vast new pools of public money are operating under a system of actively weakening oversight. Recent legislative rollbacks to the authority of the KPK, Indonesia's official anti-graft agency, compromised the country's institutional safeguards against corruption. International credit rating agencies took notice. Moody's explicitly revised Indonesia's economic outlook to negative, citing reduced predictability in policymaking and a clear erosion of governance. When Indonesia most needed ironclad fiscal discipline to navigate a global crisis, its internal economic machinery was buckling under the weight of excessive spending. The immediate danger for Indonesia now lies in a mathematical trap built entirely around fuel. Because the government refuses to cut consumer fuel subsidies while global oil prices surge, the national budget is forced to absorb the difference. For every dollar global oil price nearing $100 a barrel, this subsidy math pushes the budget dangerously close to the strict 3% deficit limit. Breaching that cap shatters the country's macroeconomic credibility. This trajectory has many economists asking a disturbing question. Is Indonesia sleepwalking into a repeat of the 1997 Asian financial crisis? If the administration refuses to dramatically curb its spending, the endpoint is mathematically predictable. The country faces uncontrollable capital flight, skyrocketing domestic inflation, and ultimately the humiliation of being forced into another massive IMF bailout. A crisis of that magnitude would wipe out 2 decades of hard-fought economic progress and devastate the modern Indonesian middle class. The financial turmoil of early 2026 proves that no amount of political ambition can outrun uncompromising economic reality.